They were already in the room. You just weren't invited. Late afternoon, London, a private boardroom overlooking Canary Wharf. Three of the largest financial institutions in the world sat across from Ripple's representatives. The conversation was not about charts. It was not about speculation. It was spreadsheets, cost models, and projected efficiencies. And someone who was in that room just told us exactly what they discussed. While retail investors spent the last 2 years debating price action, the decision was already being made in a room most people will never see the inside of. Today, I am going to walk you through what was said, what it means for your position, and why the signals coming out of London and Frankfurt right now are not noise. Because once you understand what those banks were actually calculating, the whole XRP thesis resets. Welcome back. If this is your first time here, this channel is not a hype channel. We don't do hopium. We track the institutional moves, run the numbers, and explain the mechanisms that the mainstream crypto crowd either doesn't understand or doesn't want to talk about. Today's deep dive, Lord Belgrade, the London Frankfurt ETP pipeline, and the one piece of math that explains everything. Let's get into it. Here is the hard truth that almost nobody explains correctly. XRP is not a bet on crypto going mainstream. It is a bet on the existing financial system choosing to replace its own plumbing. That is a fundamentally different thesis, and most retail investors miss it entirely because they're inside the crypto bubble. Lord Belgrade spent 2 decades inside global banking. He describes himself as a former City of London director overseeing cross-border settlement strategy. Over the last few weeks, he's posted a series of disclosures about what he saw during meetings between Ripple and major financial institutions. And whether you trust every detail he shares or not, the framework he's describing matches what we can independently verify from on-chain data, regulatory filings, and institutional behavior. Here is what was on the table in that boardroom. 1 XRP equals 1 million drops. The average transaction on the XRP ledger consumes 10 drops. That's 0.00001 XRP per transfer. As long as those 10 drops cost less than $1 total, the efficiency argument for banks is airtight. Cost of settlement drops, margins widen, transfer times go from days to seconds. Now some people heard that and jumped to a bad conclusion. They said, so XRP is capped at $100,000 or the math breaks. That is not what he said. At $100,000 per XRP, 10 drops costs 1 cent. The math still works. What Lord Belgrade was pointing at is not a price ceiling. It's proof of how the ledger was designed. It remains functionally cheap for banks at virtually any realistic price. That was not an accident. That was an engineering decision made with institutional settlement in mind. And here's what makes this different from every other crypto story you've heard. The only remaining obstacle he named is not technology. It's compliance. KYC, AML, identity verification frameworks, the compliance layer. Lord Belgrade said it directly. Once those are fully synchronized with the XRP ledger, the banks in that room have no remaining obstacle to deploying it at scale. The technology is built. The business case is proven. The legal and compliance infrastructure is what's being finished right now. Think about what that means for timing. You also need to understand something about Lord Belgrade's broader take. He posted recently that he's seen NDAs, quiet meetings, and behind-the-scenes alignment between central banks and Ripple for nearly a decade. His conclusion? Nothing has changed. Everything is moving exactly as those early private agreements outlined. He sees no alternative technology that has displaced the original design. Not one. That's a man who was inside the room telling you the blueprint didn't get thrown away. Now let's connect that to what he said about London and Frankfurt, because this is where it gets specific. Lord Belgrade gave a direct instruction to people paying attention. Watch London and watch Frankfurt. He said the groundwork for a significant XRP ETP across the UK and EU has been quietly taking shape. Regulatory frameworks, custody solutions, and institutional access points are finally aligning. His word was quietly, not loudly, quietly. Here's what's actually happening on the ground in both cities. London is Ripple's strategic European base. The company is in the process of opening a major new office inside the core banking district, not in a tech park, in the banking district. The purpose is direct engagement with banks, regulators, and financial firms on tokenization and digital payments. Ripple has been actively participating in UK policy conversations, specifically to align its products, including XRP liquidity instruments, inside the new digital asset regulatory framework. The leading candidate for where the first major XRP ETP lists in Europe is the London Stock Exchange. Frankfurt is the other half of this equation. Germany's Xetra exchange already carries multiple crypto ETPs. The institutional infrastructure is in place. The custody solutions exist. The access pathways for major asset managers are built. Ripple has spent years working with digital asset alliances and investment firms in Frankfurt. The pieces are there. The question is not whether this product launches. The question is whether you're positioned before it does. Now, let me put the institutional behavior piece in context. Does a multi-trillion-dollar asset manager move into a new product without absolute legal certainty? No. They don't gamble at institutional scale. They don't speculate with their clients' money. They build the legal opinion. They file the paperwork. They wait for the green light, and then they move. What we are watching right now is the quiet before the opening. Lord Belgrade also mentioned something that I think most people dismiss too quickly. He said Ripple's technology has already touched the infrastructure that powers Visa Direct, MasterCard Send, and American Express FX international payments. He called them test beds, not announcements, not press releases. Quiet experiments inside the rails that move trillions of dollars every year. Here's what you need to understand about how corporate adoption at that level works. When Visa or MasterCard integrates new settlement infrastructure, they do not send out a tweet. They run it, they validate it, and then one quarter it just appears in an earnings call footnote. That is how this happens. The announcement is not the beginning. It is the confirmation of something that already worked. Let me pull up the math now because this is the section most people skip, and it is the section that explains why institutional interest in XRP is not a passing phase. The global derivatives market, you've heard the number, but most people have not actually sat with it. $1.2 quadrillion, not trillion, quadrillion. The entire global stock market is roughly $100 trillion. The derivatives market is 12 times that. Interest rate swaps alone represent the single largest segment, and Lord Belgrade specifically called that out. Millions of lawyers, millions of traders, millions of accounts, all requiring clearing and settlement systems that are, by most expert accounts, expensive, slow, and full of counterparty risk. Dodd-Frank regulations tried to address it and produced thick rulebooks that fixed almost nothing about the actual efficiency problem. Ripple's position is that distributed ledger technology can simplify the entire clearing and settlement stack for derivatives. If even 1% of global derivative settlement flows through XRP-based infrastructure, we are talking about $12 trillion in annual settlement volume touching the ledger. And that's just derivatives. Let me add the rest of the stack. Cross-border payments, $150 trillion per year. Foreign exchange turnover, $7.5 trillion per single day. Nostro and Vostro float. That's the money banks lock up in correspondent accounts just to grease cross-border transfers. Roughly $27 trillion sitting idle at any given moment, earning nothing. Ripple's on-demand liquidity system is specifically engineered to eliminate that float. The locked capital gets freed up. The cost of maintaining correspondent banking relationships drops. Settlement happens in seconds instead of days. Now let's look at XRP's supply against that backdrop. Total supply is fixed at 100 billion. No one can mint more. Circulating supply sits around 55 to 57 billion. Exchange reserves based on on-chain data are at multi-year lows right now. Less liquid supply on exchanges is a direct indicator of accumulation. Tokens don't walk off exchanges by accident. Here's the math that retail investors ignore most consistently. Moving large dollar values through ODL corridors efficiently requires XRP at sufficient price to minimize slippage and provide liquidity depth. Higher price does not make this system worse. Higher price means fewer tokens needed per transaction, which actually improves settlement efficiency at institutional scale. The system works better as price goes up. That was an intentional design choice. This is not a prediction. It is a system requirement. And then there is tokenization. Estimated market size for tokenized assets by 2033 sits between $20 and $30 trillion. Funds, fixed income, equities, real estate, lending, derivatives, treasury management. The XRP ledger, with its existing compliance layer and Ripple's decade of institutional relationships, is not a sideline observer to this market. They are one of the primary candidates for how tokenized value crosses borders. David Schwartz himself said it. Institutional adoption paves the way for the next wave of retail adoption. If DeFi is going to replace traditional finance, it has to do all the boring things traditional finance does. Institutional adoption is how that boring infrastructure gets built. He said boring deliberately. He meant scalable, compliant, and irreversible. Where are we in the sequence right now? The compliance gap that Lord Belgrade identified is closing. The Digital Asset Clarity Act in the US, the evolving stance from the FCA in the UK, and the EU's MiCA framework are all converging on the same outcome: clear, codified rules for how banks can legally touch digital assets. Ripple has been inside those policy conversations the entire time, not watching from the outside, actively shaping the framework. The XRP-ETP pipeline in London and Frankfurt is not speculation. The custody infrastructure exists. The regulatory frameworks are nearly aligned. Lord Belgrade said it is taking shape quietly. That word choice matters. Quiet alignment is how these products actually get built. When this launches, it does two things simultaneously. It opens institutional access in two of the most important non-US financial markets on Earth, and it creates compliant liquidity depth that the current market does not have. European institutional money operates under different rules and different timelines than US capital. An ETP in London and Frankfurt is not a duplicate of the US ETF story. It is a separate wave. The window here is not measured in years. It is measured in quarters. And here's how to know when you're inside it. Watch Ripple's London office announcements. Watch what lists on Zetra. Watch which custody providers publish their XRP integration news. Watch who files prospectuses with the FCA. Those are the signals, not the price chart. The price chart is a lag indicator. The filings are the leading indicator. When the wait-and-see institutional money finally has a regulated product to buy, it does not enter gradually. Risk premium disappears and repricing happens fast. That is what happened in the US. That is the same dynamic being built in Europe right now. Lord Belgrade said something this month that most people glossed over, and I think it is actually the most important structural insight he shared. He said XRP's presence on major centralized exchanges may be more of a constraint than a catalyst. When an asset built for institutional liquidity is trapped inside retail-driven speculative venues, price discovery gets distorted. Real value cannot emerge until XRP operates primarily inside the rails it was designed for: institutional settlement, cross-border flow, and on-ledger utility. He is describing the current state as transitional. The crowd staring at the order book on Binance or Coinbase is watching the wrong screen. They're tracking sentiment. Institutions are tracking compliance calendars and custody infrastructure timelines. Those two things are not measuring the same reality. Here is the scarcity piece that matters. Once tokens move into multi-signature institutional custody vaults, they do not come back to market for a 10% gain. They are locked for operational settlement purposes. Every token that enters institutional infrastructure is functionally removed from the retail order book permanently. Exchange reserves are already at multi-year lows. This is not a coincidence. This is the accumulation phase finishing. When the regulatory green light arrives and the ETP products launch, the risk premium on XRP disappears almost overnight. The price gap that happens in that moment does not give you time to react. You either own it before or you watch. Real change doesn't announce itself. Lord Belgrade said that. And it is exactly what we have been watching. Quiet office openings in London, quiet conversations between Ripple and central banks, quiet technical experiments inside Visa and MasterCard infrastructure. None of it made front page news. All of it moved the structure forward. I know it's been a long wait. I know the charts have been frustrating. I know the people who told you to be patient 2 years ago sound exactly the same as the people telling you to be patient right now, and that starts to feel hollow. Here is what I can tell you as an analyst rather than a cheerleader. Being early feels exactly like being wrong, right up until the moment it doesn't. The red candles over the last year have not changed the institutional thesis. They have deepened it. Every week of sideways price action is another week that institutional buyers accumulate at low cost before the compliance infrastructure finishes. The volatility you see in the chart is noise. The custody solutions being built in Frankfurt are signal. The Ripple office opening in London's banking district is signal. Lord Belgrade saying nothing has changed from what was agreed behind closed doors a decade ago is signal. The question isn't whether XRP's price will reflect its utility. The question is whether you'll still be holding when it does. The crowd panics. The patient investor watches the structure. You are not here by accident. You found this channel, you watched this video, which means you are already doing what most people are not, paying attention to the mechanism, not just the price tag. Let me summarize what we covered today. A former City of London banker told us what was in that boardroom meeting. The math was irrefutable then, and it's irrefutable now. The compliance gap is closing. London and Frankfurt are building the ETP infrastructure as we record this. Visa, MasterCard, and American Express are running quiet experiments on Ripple's rails. Exchange reserves are draining. Institutional custody is building. And a man who was inside the closed-door meeting says nothing about the original plan has changed. The architecture is finished. What we are waiting for is the moment the world is officially told what has already been built. They were in the room planning the future. The only question left is whether you're in position when the rest of the world finds out. If this breakdown gave you clarity, drop a comment below with the word boardroom so I know who made it to the end. Stay rational. Stay positioned.